undergoes the product, it buys it from someone else. So what was the price it bought it at? What profits did that entity outside Nigeria make from selling that product to you? So the tax authority will look at both the tested party and the transfer pricing method to ensure that they align with what they expect. So for instance, in transfer pricing, we have 5 common methods. The comparable uncontrolled price method, COP method, the resale price method, the cost plus method, the transactional net margin method, and the transactional profit split method. So for instance, you may have bought a product at a commodity and then just use the TNMN, which is the most common method used to price it. And the tax authority may say, no, there are COP methods. COP is actual prices. There are maybe reference rates globally in the industry for that product, and you have to use that to ensure that, and they want to use that to ensure that the prices were at arm's length. So these are some of the things you may see happen under this head. You could also see cases where the tax authority wants to review the allocation keys that was used for cost allocations in cost bases that are then used for markup, and it will be either way, either in cases where Nigeria is charging or in cases where Nigeria is being charged a cost. And the 5th one we noted there, even though it's not strictly a transfer pricing issue, what we see, sorry, thought someone was saying something. What we see in practice is that the tax authority also tries to look into transaction taxes, value-added tax, withholding tax. Sorry, someone else's mic is unmuted. There's a background noise. Okay, so sorry about that. So the tax authority wants to see that adequate transaction taxes are being paid on the related party transactions. So for instance, where it's a case of under the reverse charge mechanism, they want to see that the Nigerian entity has self-charged itself when it's receiving services from related party outside Nigeria, for instance, withholding taxes also. So this is one area we see in practice that the tax authority also looks into in transfer pricing audits, even though you could argue that it's not strictly a transfer pricing issue. And the last one, I think we also mentioned it in the earlier session, is the permanent establishment assessment. When the tax authority constructs or reconstructs that the structure of the related party relationship and the value chain within the group, one key risks we also see come up in transfer pricing audits are cases where there's a permanent establishment risk or a SCP risk. For instance, where the entity outside Nigeria is just performing services to the Nigerian company. Most likely, is there a SCP risk? For instance, if it's a service SCP, has the appropriate withholding tax being charged? If it's for services that and when you are doing the functional analysis, when the interview is being done, are the people performing the services are they coming into the country? Are they creating a P? Or when it's based on contracts between the foreign related party and third parties in Nigeria, where the Nigerian company being audited performs part of the services that leads to the reporting of revenue by the entity outside Nigeria, as the activity of the Nigerian company created a permanent establishment for the foreign related party. So these are some of the examples of establishment of permanent establishments. Establishment of permanent establishments. I noticed I said that twice, but basically these are some of the examples where you see permanent establishments being arising or existing in transfer pricing audits. Okay, so these are the common areas. So I would just want to briefly talk on high-risk transactions. No need to dwell on it again because we've also discussed them in the last session, and I talked about them earlier. But like there is a need to just re-emphasize them because these are some of the transactions that we see come up over and over again in transfer pricing audits. When it comes, for instance, to services and intangibles, because these are not tangible products. If you are selling a product to someone and the tax authority is saying, what is this? You can easily show them that this is why I'm paying my related party, see the product I bought. But when it comes to things we cannot see, intangibles and intra-group services, for instance, you need to go the extra mile to actually show the tax authority that you received benefits from this service. So, for instance, when we're talking about intangibles, some of the things you will need to prove in a transfer pricing audit is, does the agreement have substance? So, for instance, is your related party just charging you a royalty? Sometimes the related party may be charging you for using a trade name. And I've experienced in an audit where the tax authorities is saying, why are they charging you for using their name? As far as we're concerned, it is the business in Nigeria, including the marketing spend in Nigeria, that created that brand. That brand was nothing before it came into Nigeria. So, for instance, does the agreement have substance? You need to be able to prove to the tax authority that the related party that is charging the Nigerian entity for the use of that name in this example was involved in the development of that trade name, was involved in its marketing and in getting it to where it is today. Does it provide the recipient with benefits? So, for instance, if you say the transaction is one for technical know-how, how does the entity use the technical know-how to improve its processes in Nigeria? Who is entitled to the economic returns? Because it's one thing to say, yes, there is an intangible product, but from a transfer pricing point of view, we then need to get to a point where we conclude on who is entitled to the economic returns arising from that intangible. In transfer pricing, the economic owner of an intangible product may be different from the legal owner on paper. On paper, you can say the legal owner of the intangible is your entity that is located in Mauritius, for example. But it may be that that software, for instance, was developed, the maintenance enhanced in Nigeria, but the owner of the IP on paper is in Mauritius. The tax authority will then be saying, no, as far as we are concerned, this software is a Nigerian software. Instead of you paying, in fact, every other entity all over the world should be paying Nigeria for using it, even though you're not the legal owner. So that's a key question that always comes out in transfer pricing audits. Who is entitled to the economic returns? So the next question is the pricing at arm's length. The next thing the tax authority may look at is what's the pricing. For instance, if you say it's 5% of revenue that will be paid as the royalty, is that right? The tax authority may want to do a benchmark in that case. And of course, in Nigeria, for instance, is the fee excessive? We look at the cap on royalty fee. If you look at Regulation 7.5 of the Nigerian TP regulations, there is a cap based on EBITDA on the royalty fee that should be charged. So those are some of the points that if there's an intangible transaction, these are some of the things that the tax authority will look at in determining whether a TP adjustment is required. And that's why we say intangible transactions are always high-risk transactions. The next one is procurement arrangements. You may have an arrangement where the Nigerian entity is purchasing products maybe from Asia, but maybe because of capital reasons, or maybe because of economies of scale, or in cases where the suppliers do not want to deal directly with Nigerian entity, or because of forex, there may be multiple or several reasons for different groups, but there may be reasons why instead of the Nigerian company buying directly from suppliers, there is an entity within the group that acts as a procurement agent and purchases the products and then sells to the Nigerian entity. So the questions the tax authority would want to look at is the functional profile of the procurement agent, Is it a procurement agent? Is it a distributor? What's the substance? Why are you not buying these products directly? What's the need of that entity in the chain? What's the benefit? Is it just a channel? Is it a case that is the Nigerian entity that is actually performing all the procurement functions and just paying additional money to its related party outside Nigeria? So these are some of the questions that are asked. Documentary evidence, based on the Nigerian TP regulations for procurement arrangements, you have to keep as part of your transfer pricing documentation, third-party documentation of the procurement arrangement, including the original invoice, supplier invoice, that's for the transaction between the procurement agents, your foreign related party, and the third party. So these are some of the things that raise controversies on procurement transactions in transfer pricing audits. Intercompany financing, I think I've spoken about whether it's a loan or equity, where we're talking about delineation of transactions. Other things the tax authority will look at is what's the need of the loan. Is the loan an artificial loan just to move money out of Nigeria's interest? Is the interest rate at arm's length? We also have EBITDA rules in the schedule to CETA, now scheduled to the Nigeria Tax Act, scheduled to the NTA on the interest expense that can be deducted in each year before the rest is carried forward to subsequent years. So these are some of the things the tax authority, NRS, will look at in transfer pricing audits of financing arrangements. Intra-group services, we've also spoken about it a bit. Tax authority will look for substance of the transaction and benefits, proof of actual performance, look to see that it's not a duplicated service. So for instance, if you see in some groups that you see management services, you see management expense, management fee being charged to a Nigerian company by two different companies. One is called maybe the headquarter, and then another one is called the RHQ, the regional headquarter. So you then see two management fees, and then the tax authority is saying, what's the difference between what the regional office is doing and the head office? What's the difference? Is that a duplicated cost? Or it could also be a case that the entity itself maybe has a legal team, and then the tax authority also sees legal service fees coming from headquarter. And then the question the tax authority will be asking is it a duplicated service? Why are you receiving a cost, a fee, a charge for a service that you perform yourself? So in the first place, it's something that your documentation should be able to show. By the time you are doing your local file, your TP report, you should be able to distinguish between what is done in-house and the cost you receive. And if that has not been done appropriately in your documentation, the second chance during the audit will then be there to meet these queries with responses, because these are some of the common things you see come up in these high-risk transactions. So that's for it. Like we said, there are others. These are just some of them, and I think we also even talked about some of them in other slides and even in the previous presentation. Okay, so I hope I'm not going too fast. I was thinking we could give ourselves some time back. Going into some of the common pitfalls that we see companies fall into in transfer pricing audits. Sometimes you see companies come at the last minute when they've received, I don't want to call them ridiculous, when they've received alarming assessments from the tax authority. Sometimes when the tax authority is asking for information, companies may drag their foot, but when they see an assessment, it's an eye opener that it's something you need to attend to immediately. So these are some of the common pitfalls we see come up in transfer pricing audits. The first one is cases where there is lack of or inadequate documentation. The inadequate documentation may be, for instance, the actual local file. The example I gave was of just now of maybe your local file did not justify your intergroup services, and the benefits that you received. It could also be other documents that should support your local file. So for instance, in the procurement transaction, we talked about documents that the tax authority may ask for. Apart from that, do you have an audit defense file that's made up of every other thing that will prove each of your related party transaction? When Adefemi was speaking earlier, he said it is not at the point of the transfer pricing audit that you should start rushing to get them. Because one thing is sure, no matter how much you get during that period, it will not be the same as if you had kept those documentation as at the time or just shortly after the transaction occurred, because there's staff turnover, people will leave, systems will change. You see, I can't count the number of audits that my client has told me, oh, by the time that year we're using this system, this year we've changed to SAP or we've changed to something else. So all those information are not available again. So these are some of the, this is one of the common pitfalls in transfer pricing audits, lack of or inadequate documentation. I don't want to give an estimate, but I would say a large chunk of the assessments that companies get in transfer pricing audits arise due to lack of documentation. Not because those transactions were actually not at arm's length, but because the company cannot prove it. So the company would have to get to a place of compromise to ensure that that audit closes, because that information does not exist. Okay. The next one is treating in a transfer pricing audit like a regular audit. And I think I've mentioned some of the points here, so I will not rehash it. A transfer pricing audit, even though the process seems similar, is different in content. So it is not just about showing documents, but it's about showing proof of conduct and showing proof of why the value has been allocated to each member within the group. So a transfer pricing audit needs to be treated like a transfer pricing audit. Missing response deadlines, apart from the threats that you get of penalties, potential penalties, when you miss deadlines, remember we also mentioned that it's an audit trigger where you don't have appropriate documentation, when you don't provide them. And then when you miss deadlines, you are also passing a message. The tax authority is more suspicious, and the tax authority may also see you as someone that doesn't want to cooperate. Inexperience and lack of proper guidance from experts. Transfer pricing, of course, sometimes it's a case of management of companies who may say, oh, why do I have someone in my finance or in my tax if I need to get a consultant to support me in a transfer pricing audit? I'll just go back to the words of Mr. Tayo at the beginning when he was talking about the relationship between transfer pricing and other aspects of tax. So you need to treat it in unique nature, that and recognize that it's unique and that you need proper guidance in every step of the way to establish conduct, to establish why value is where value is. For instance, the tax authority may be asking you a simple question during, I said during the field audit, they do interviews for different people. And the question may seem simple and innocent, and not because you want to lie or because you want to misdirect. You may not just understand why that question, and the way you may answer it may also not be wrong, but may not address the issue and then lead to unnecessary friction post-audit, because it's at the reconciliation stage that when you're trying to clarify, the tax authority will be saying, but you said this, we have it in the minutes that were signed that you said this. So this is a common pitfall we see in transfer pricing audit. Discrepancies and inconsistencies in documents. Of course, it's not just a pitfall in TP audit, it's also something that you see in normal tax audit. And the lack of continuity, I think I talked about this point. Employee turnover, especially where you've not kept documents, where you don't have proper handover to ensure that the system continues. And of course, because it's not transfer pricing audit, like we said, it's not limited to the finance team. It's not even mainly the finance team. The employee turnover may be for people in sales, for people in marketing, in IT, and those are the people maybe in that audit that are key to that audit. And then the tax authority is asking questions about 5 years ago. And then, of course, the people here do not know about what happened 5 years ago. So, but if you have a transfer pricing system, that recognize that as a major function within the group and kept adequate documentation as at the time that transaction occurred, or as at the time those people were there, it makes the process, it mitigates the risks. So this is the last slide, just to note, I think we've mentioned, I wouldn't dwell on it, we've mentioned some of the tax reform impacts, talking about timing of withholding tax, twice the rate for transfer pricing, for transactions with related parties, how the withholding tax event occurs at the point of accrual, even when payment has not been made, about the clear legislative framework, for instance, that now defines related parties, the arm's length principle that was first introduced by the Finance Act in reference to the transfer pricing regulations, now has a separate section in the law itself. I think I talked briefly about the intercompany financing. When compared to the Finance Act, you now see that the 30% EBITDA rule is now applies to all related party loans, not just foreign related party loans. You have lots of sections now that are focused on cross-border relationship, including minimum ETL, CFCUs, where the entity can live without dividends, etc. in the NTA. If you go to section 17, there are now rules for determining profits of Ps, SCPs, credit rating, what a credit rating to establish where the entity is doing similar business with a Nigerian entity, how that may create a P for the entity. You have so much more rules with respect to related party transactions in the Nigerian Tax Act. And this fifth one is unique because it's an argument some taxpayers used to have in the past, because transfer pricing audits traditionally, because if we know, like when I started, I talked about how the transfer pricing team within the Nigerian Revenue Service has expanded. But at the end of the day, we just have one transfer pricing office in Ikoyi that is servicing the whole of Nigeria. So of course, not all audits can hold at the same time. So you find out that when an entity is being audited, you have a large chunk of years that are being audited at the same time. And so if it is, for instance, 5 years, you then have a case where the tax authority is trying to review a year that is statute bad, and maybe because of how long transfer pricing audits takes, it's by the 8th year that they want to now release report of the prior year, and then the argument will be, oh, that year is now statute bad. Now the NTA now says that once the audit has commenced within that 6-year period, it can then continue within beyond that 6 years until the final report is provided. So I think I'll just end at this point. We'll have the joint question and answer session. Just to note that, of course, transfer pricing is becoming more and more important, and that to be able to navigate the risks, especially as the scrutiny has increased, the best way, or the first strategy is to plan early and to operationalize transfer pricing. It eases the entire process during transfer pricing audits. Thank you very much. I will hand over at this point back to Madam Veronica, our moderator. Thank you.
Thank you so much, Mr. Joseph Alatishe. It's been a very wonderful session. Yeah, thank you. And you can see the appreciation emojis from the participants. So we have some people who have raised their hands. I want to believe they want to ask questions. So I'll call out the names one after the other. We have about 6 hands raised, and then I'm sure you and Olaofe are able to do justice to the questions. I'm sure he's still on call. Okay, so Raphael, can you unmute and speak and ask your question? Raphael? Ibrahim Fatai, kindly unmute and ask your question. Olumide Oladimeji. Okay. Peter Musa. I hope we're not having challenge speaking. If we are, we can drop our questions in the Q&A box. Peter Musa. Please, any of the people with their hands raised, kindly unmute and ask your question.
Thank you very much, madam. My name is Toyosi Taiwo, and thanks to the presenters. Thanks for the job well done. My question is, my comment is in form of question and shall I say advocacy on this subject matter. Just like the second presenter, that's Joseph Alatiche said, we have instances where transfer pricing becomes more subjective than being objective. We have situations where even after you've proven all your position, there are still instances where the revenue may still want to go overboard just because they have the mandate of getting more revenue, more tax from the taxpayer. So is there anything that can be done, even at the level of our Nigerian tax law, where taxpayers can be protected under transfer pricing? Because you and I know that transfer pricing has to do with a lot of statistical data, which parameters may differ, even though we may be choosing the same TP method and things like that, but the parameters and the way data are being collected differs. And also knowing fully well that Nigeria, we have few data to play with, So what is the Institute doing? What can be done to protect taxpayer? I don't know if that question is clear. If it's not, I can definitely expatiate on what I'm trying to drive at. Thank you.
Please, we can have any one of you take the question. Adefemi Olara and Alatiche Joseph. Please, any one of you can react to the question.
All right.
Thank you.
Maybe I should start reacting, and then I don't know if Adefemi would want to, for some, okay, will want to add to it. So to start, I do not think, I wouldn't say the tax authority was it, I don't know what to use, being high-handed in their, what's it called, in their implementation of transfer pricing rules. Of course, transfer pricing has a place of judgment in it, and the judgment of the taxpayer and the judgment of the tax authority may differ. And that's why we're saying from a TP audit preparation and
Sister,
audit
okay,
phases. There are minimum requirements or minimum things you should keep so that it takes care of that flexibility. It is also the hope that even with the Nigerian Tax Act, Office of the Ombudsman, which has not really kicked off, of course, a more streamlined legal procedure or legal process. It's hoped that it will curb any instance of excesses, especially, of course, in every human interactions, two of us must not always agree, especially in areas where we have a set of rules, but they are principle-based, and there may be difference in interpretation. But with that, generally, as a company, the minimum we should do, for instance, is have this minimum documentation requirements that we spoke about. I don't know if that fully answers your question, but what I'm saying is that you can't, at the end of the day, curb the powers of the tax authority to review the books of companies, for instance. That is why the law is there. That's why remedy is supposed to be there to assist taxpayers that do not agree with the tax authority's position. They would have to take a position, and the Office of the Ombudsman can also help.
Okay. Hello, this is ICAN-ngr. Can you hear me?
Yes, we can.
Okay. Let me say, without fear of contradiction, to say, first of all, when we talk of subjectivity, the subjectivity area, or the area that are subjective, are also within objective area. So NRS does not, based on my experience, and I've done it for a while, will not just come with something that is not defensible when they come before a court. Mind you that when it comes to transfer pricing, litigation is very easy. And all documents that will have been prepared from day one will be available for review by arbitration. And I know that we have had one case decided in court here. So NRS can only be subjective as far as objectivity is concerned. Let me give an example. There are 5 known methodologies for selecting, 5 known methods you can use to test a transaction. NRS is only allowed, or any tax expert can only take one out of that 5, or anyone you are putting forward. So as far as their subjectivity is concerned, their subjectivity is only limited to selecting one of them. They cannot go, outside it. If they go outside it, they also need to provide a reason. But let me tell you, because this is also the closing remark I'd wanted to do, but let me, is a good point. Is to say it. As at this moment, we have very. Hello. Hello.
Yes.
Hello. Somebody needs to mute you. Somebody is
Kindly
calling.
mute, please. If you're not speaking, kindly mute.
Please. All right. Most tax professionals do not actually speak the language of transfer pricing. That's what we observe. Hello. So now, when there is a case which we are privy to, which NRS has been on it, I think for about 5-6 years, and the case was referred to our firm. And when I read the very first report issued by NRS, FRS then, and the case is still on as I'm talking to you, which was, the report that was raised initially, all the people that responded to it, and I think about 3 different tax firms have responded to it, NRS just continued to respond to each one of them to say, you have not responded to my issue. So when it comes to transfer pricing, yes, there is subjectivity, but objective must be within known criteria. So it is required that people must have adequate knowledge of transfer pricing before they respond. Now, if you also read the judgment on a Prime Plastic, and the only judgment that came out from the court, that was actually what the the appellant were claiming to say they use some subjectivity, but NRS came around to present their own position. Unfortunately, the appellant did not address any of the issue. And if you read the judgment, the appellant lost on all counts, not because NRS was completely right, but if you don't speak my language, there's nothing we can do. We are not communicating. So the summary of it is that let's learn not to treat transfer pricing as if it's just any other tax matter. It has its own language, it has its own ways of doing things, and if you don't speak that language, NRS easily know when you read your response whether you are speaking the language or not. And when you're not speaking their language, it's very easy for them to dismiss it and say, come to the table and talk. You are not talking my language. That's my comment.
Thank you very much, sir. Okay, we still have two hands raised, Ibrahim Fatai and Raphael Alabi. Please, you can unmute and speak. While we would kindly note that an attendance form has been dropped on the chat, especially for those that are joining on YouTube. So kindly click on that link to register your attendance to ensure that you get your MCPD credit. So Raphael Alabi, can you unmute? Ibrahim Fatai. Okay, while we wait for you, we will go to the question and answer box. Okay, so let me read out from the question and answer box. Someone is asking if there's a generally acceptable categorization of risk heat map because different corporations are bound to have divergent classification. That's from Dr. Segun Olorunlero.
All right, thank you, Mrs. Oti. I can take that. So, I mean, my answer would be yes. I mean, while you might have different organizations customize their own risk framework, there's a general risk heat map that you typically will see, which is based on likelihood versus impact matrix, right? So if you have low impact, then it means low risk. If you have medium impact, it means low risk. If you have high impact, you have medium risk, something like that. So it generally does not change. So the way you will now categorize your transactions, again, may be influenced by your industry. It might be influenced by your risk appetite. You know, certain companies have very high risk appetite. Some others have lower appetites. You could also have industry regulations, for example, influence how you categorize your risk. If you have, you know, industries that, you know, have specific regulations around controlled transactions, for example, the financial service industries, the banks, you know, you could have high risk where you have certain transactions. You could also have governance requirements. Certain companies have higher threshold, you know, for ensuring that governance is, you know, is compliant. So depending on the nature of organization that you work with, you know, it will determine how you allocate risk. But generally, in terms of impact, it's the same: low, medium, and high. I hope I answered that question.
Okay, just to also corroborate what Femi has said, I think the fundamental question is, what is really transfer pricing aiming at? What is the risk we are talking about? Transfer pricing is a means to determining whether a company has paid appropriate tax liability. And when it comes to assessing a risk, yes, there could be industry risk, whereby if I say a manufacturing sector in Nigeria, what are the risks they may likely have in the manufacturing sector in Nigeria? If they are buying imported raw materials or anything they are importing into the country and they are doing from related party, there is a risk around that area in terms of pricing. If you're in the oil and gas, most likely equipment, intellectual property, you're also getting from related party. If you are in the banking industry, when you are raising finance or you are giving out loan to related party, those are industry risk. But all these risks are pointing to just one thing for everybody. What am I paying appropriate tax or not? So, and that is where transfer pricing is going to. And this is what I've always told people that are working, especially on transfer pricing. Your knowledge of tax law must be top notch. You must know everything about the tax law, especially decisions, provisions of the law, judgment that has got to do with international transactions, knowledge of double taxation, double tax treaty. So all those ones must be your working tools, because transfer pricing is coming back to say, have you paid appropriate tax or not? So when you are assessing a risk, your risk analysis for whatever company you are is to say, this related party transaction that I've done, how much has it affected the final tax liability that I'm going to pay? When the tax man comes and use the transfer pricing tools and their knowledge, they are coming back finally to say whether you have paid appropriate tax or not. So they are generally acceptable categorization of any risk is to say what is the final tax payable, what will be the final tax impact, and that is what is common to all of them. There may be industry risk peculiar to different segments, which FRS will have experienced there before, but finally they are just coming back to your final tax liability. That's the way to go about risk mapping. Thank you.
Thank you so much. The next question here from Fatima Rufai says the NRS does not clearly spell out companies that must file transfer pricing. I currently do TP for a non-life insurance company that I believe do not need to file at all. Can you please give a guideline accordingly? I don't know if you get that question. What kind of guidelines should be requiring?
I can take that answer, and Ogatayo or Joseph can corroborate as needed. So the Nigerian transfer pricing regulation, the old version and the new version, the version of 2012 and the version of 2018 clearly spells out, companies that should comply with transfer pricing. If you look at the regulation, it says that if you engage in controlled transactions, you should comply with the preparation of transfer pricing local file to substantiate your transaction. You should file your return. So that is clearly spelled out. Now the question is, what transaction would I engage in that would make me fall within that category? Now there are several transactions that are specifically listed around sale of goods, purchase of goods, intangible transactions, financing transactions, and any other transaction that may currently or subsequently affect your profit or loss. So it could even be a balance sheet transaction. For example, you have a richer transaction that involves flow of cash. So if you have those types of transactions with an entity that is connected to you, then you are expected to comply. Then the next question would be, who is a connected person? Now, the NTA, if you look at the NTA defines a connected person as someone that is related to you either by management, ownership, or may have significant influence over your financial, economic, or commercial decisions. So you would see that this is a very wide definition. So it means that if you have a director, for example, that is on the board of company A and company B, if there's a transaction between company A and company B, such transaction will bring will bring both companies into the scope of transfer pricing. Same thing goes to a shareholder that owns shareholding interest in company A and company B. Now, unfortunately, the TP regulations in Nigeria do not specify shareholding interest. So it means that irrespective of how much interest you own in both companies, any transaction between both companies would bring them into the transfer pricing compliance scope. Now, if you are an ultimate parent entity, right, and you have subsidiaries that own companies in different jurisdictions that transact with each other, if those entities transact with each other, it means they would also need to comply with the transfer pricing rules to the extent that they are in Nigeria. Now, there is also a very broad definition of how it might impact transactions between third parties and companies in Nigeria. I mean, this is still debatable, but if the tax authorities can prove that a third party has significant influence over your revenue and your costs, such that they can determine whether you are profit making or loss making in any year, then they could argue that such transactions should fall within the scope of transfer pricing, and they could actually audit that company for transfer pricing purposes. I mean, this is just the broad definition. I'm open to Joseph or Gataya to add as needed.
Thanks a lot, and you've addressed it. However, just to keep it very simple, buttress what you have just said. There are two types of compliance requirement. That is what you need to file every year, which is, I think, is called disclosure form. And a declaration form that you filed once you fall within TP, and you file it once at the beginning. If the related party transfer begin to change, take for instance the ownership, directors, you need to refile the declaration form. Then there is a disclosure that is required for the transaction annually, which you need to complete. I think once you have a related party transaction, you are required to complete that one. It has no threshold for value of transaction. So that is one. The other one, which I think your mind is addressing to, should I prepare a contemporaneous documentation? So now the regulation has said, let me keep it easy for you. If the value of your contemporaneous documentation is less than 300 million naira, don't bother to prepare it until I request for it. That is NRS. When they request for it, then you can ask, give me 21 days to prepare it. If it is more, you are required to prepare that TP documentation and keep it in your drawer, wherever you want to keep it, until they request for it. So summarily, disclosure and declaration form has to be filed annually, irrespective of the threshold or the value of transaction. Contemporaneous documentation is, if you are more than 300, if the value is more than 300 million naira, prepare annually. If it is less, don't prepare until they request for it. Thank you.
All right. Thank you so much. The next question from Lukman Ajibade. It says, what's the difference between a local file and the TP disclosure and declarations that are made while filing for TP? Does the local file have a strict guideline or format for which information have to be filed? Yes.
Okay.
So I don't know if
I think the commentary that Mr. Tayo just gave now answers that, but maybe just to re-emphasize it. So, like he has said, the return, the disclosure and the declaration form is the return that you file, where he said it's irrespective, you need to file. So that's the declaration form is the form that you're telling the tax authority, oh, these are my shareholders, these are my directors, these are the other companies that I'm related to, my auditor, this is him, this is my tax consultant. That's all you're saying in a declaration form. And that is why that form does not need to be filed every year, except there is a major change. There are items we call major change. And then the second one, the disclosure form, they are simply saying, these are my related party transactions in the year. These are their values. These are my related party balances. This is the method I intend to use to test the arm's length nature of the transaction. That is all you are saying in the disclosure form. However, the documentation report, that is now the one, the local file. I want to keep it simple. Of course, when we talk of documentation, we do a three-tiered documentation system. So we have a master file, local file, and then your CBCR. But for this purpose, I'll just talk about the local file. The documentation report is now the one that you would use to talk about the entity, the local entity, the Nigerian entity, and its related party transaction, to try to show that that value that I have included in the disclosure form, when we're talking about the returns, we say, you are just saying, these are my related party transactions, these were the values, and this is the method that I'll use to test it. Now, in the documentation, you are saying, oh, this is me as an entity. This is my organization structure. This is about my group. This is about the markets that I play in. This is the form when Adefemi was talking about in the first session, when we were talking about functional analysis, to talk about where value is being created. These are the functions with respect to my related party transactions. And based on all this is this is why my transaction aligns with the arm's length principle. This is the test to show based on any of the 5 methods that the transaction value that I have disclosed in the returns. This is how I'm testing it to be at arm's length. To the other part of the question, there is no fixed format of what a transfer pricing local file should be. However, if you go to the Nigerian TP regulations, if you go to the appendix, it includes all the contents, what is expected to be included in the documentation reports. As a minimum, all those items, you should be able to tick the box and say your documentation report has covered all the items that are there. And then, of course, if you go from consultant to consultant, different consultants have how they've now designed their documentation reports to fit both the OECD requirements and Nigerian TP regulations requirements. So it may differ from place to place. However, the contents should have as a minimum the items included in the Nigerian TP regulations because we are operating in Nigeria.
Thank you for that contribution, Mr. Joseph. So this question from Friday Orosaye says, what time can organization change their method on specific transfer pricing method?
I'm not sure I edit, so Adefemi, I don't know if you edit or you want to respond. I didn't hear that question.
Yes, I did. Yes, I did. So now your transfer pricing methodology is dependent on a number of factors, right? It could be dependent on the nature of the transaction. It could be dependent on the availability of information. And it could also depend on who the tested party is. So there's no specific timeline or there's no specific provision that requires you to change or use a particular transfer pricing methodology. The TP regulation that is existent in Nigeria talks about using the most appropriate methodology. So it means that for every contemporaneous year that you prepare your transfer pricing local file to analyze intercompany transactions, you need to evaluate the 5 methodologies that have been prescribed by the regulation to determine which of them is the most appropriate. So a methodology that might be appropriate in year 1 might not be appropriate in year 2. So you need to do a consistent or constant reevaluation to determine that you are always using the most appropriate methodology. I would say a lot of times, because we do not have taxpayers that have, excellent documentation, there's a consistent use of TNMM. TNMM is a transaction net margin method. But I would say from experience, and the reason why, I think goes to Mr. Taiwo's point, discussing with the tax authorities can be cumbersome. The reason it is cumbersome most times is because taxpayers might be at the mercy of, the tax authorities because they have not kept, the relevant evidence to substantiate why that particular methodology has been used. So, the fallback approach is, let's use TNMM to test the profitability of the entity as a whole entity. But remember, transfer pricing will typically require you to delineate the transactions and speak to the specific functions that have been performed within that cycle of transactions. So again, you need to reevaluate your transactions on an ongoing basis.
Okay, thank you. I will go to the next question from Abayomi Abiono. Abayomi appreciates the brilliance presentation and wants to know what circumstance will loan be reclassified as equity for transfer pricing purposes.
All right, thanks, Abayomi. There is no short answer to that. That's an entire presentation on its own. So I'll go with, I'll defer to what Mr. Tayo said at the beginning, that this is the tidbit. But anyways, going into it, if you go to chapter 10 of the OECD guidelines, it gives a lot of factors that we should consider, or that should be considered in determining whether a transaction is actually loan or equity. If you can recall what we did when we were talking about under accounting, I'm hoping that's a good example here, where we were considering whether a lease was an operating lease or a finance lease. Where we usually did that analysis, it doesn't mean that all the factors must exist before you say it is finance lease, or all the factors must exist before you say it is operating lease. It's something similar when we are talking about whether it's loan or equity. So some of the factors that will be looked at, for instance, is there a fixed repayment date in that arrangement? And remember, in all these things, it's not just about what is in the agreement, it's about conduct. So for instance, if you have a repayment date, when there was failure, what's the consequence of failure to meet that repayment date? It could also be some of the other factors are the what's it called, the status of the lender when compared to third-party lenders. Is there an interest to it? Is there a security? So for instance, if there is no collateral and it's somebody that is not does not have that credit rating, then most likely maybe that's an evidence that it's actually equity rather than a loan. So those are some of the factors there, about 8 of them, that we consider in determining whether it is loan or equity.
Okay, thanks, Joseph. And I think this is an area that buttress what somebody had asked about FRS, NRS using their discretion and exercising their judgment in a way that appears subjective. Now, and this is a very good example. Now, let us look at what is the purpose of having an equity in a company? And what is the purpose of having a debt? What are their differences? You have to note that government has technically 34% stake in the profits of every company in Nigeria, because that is what is used to provide infrastructure, pay, run government. So we don't have to go into all those ones. So when a company is operating and it is not paying tax, then the FRS attention is drawn to that company to say, why is this happening? Now, and this is where they now begin to draw. Okay, what are the circumstances under which whereby they will say, a company, also remember, okay, let me backtrack a bit. Companies also use debt and equity to play a trick on government, because we know that for debt, when is from a foreign company, the interest that is payable, once you pay withholding tax on that interest at 10%, for instance, I think for now, that is the final tax liability. These are fees when it is equity. If it is equity, you first of all pay 30% CIT, you pay 4% development levy, you pay withholding tax at 10%. So you are comparing 10% with 44% effective tax rate. So every company will like to finance from offshore their business with debt, so that they just pay a withholding tax of 10% against 44%, especially in an unregulated environment. So companies generally all over the world, from transfer pricing perspective, like to use debt to finance operations rather than equity. More so, you also take note that it is very easy to leave a country with debt. Equity takes a longer route. Now, so the taxman, being aware of this possibility, now begins to say, wait a minute, a company has been operating continuously. You have a debt instrument in your books rather than equity. And that debt, maybe you have also been paying interest to the owner, but you have never declared profit. You have just been in a net tax position. Then government begin to say, this is not fair. I want to reevaluate whether that debt should be an equity. The purpose of what they are doing, they are not saying change their books. So It's just for the purpose of determining the appropriate tax that will be payable to government. To say we'll rather reclassify that debt, as that's one possibility. Thereby they begin to say you are paying yourself, the government is getting nothing. We have a chance to reclassify. Another possibility is to say the company is not even paying itself. It's a continuous loss in the books. It's not even paying the interest to the lender, who is the owner of the company. Mind you, is a related party. They are the one that have come to fund the business here. So you have had a debt in the company, you are charging interest. When you are charging that interest, it's wiping out the entire profit in the books. So no tax is payable. More so because you have also not paid that interest to your service provider or to the owner. You also say, hey, the withholding tax is also not payable. I'm talking under the CETA arrangement, previous law. The government, the taxman is begin to say, if somebody can put down his money for a very long time without being compensated through interest payment, and is ready to do it for into another foreseeable future without getting paid, that debt has a more of characteristics of an equity than a debt. If you go to the bank, will that be allowed? Don't forget they are comparing to what a third party will permit in similar circumstances. So those are the circumstances whereby the taxman will put all these things together and say, should I consider this debt more of an equity? You hardly see vice versa to say we put equity as debt. Rather, they are rather concerned to say we rather put the debt as equity because it's more advantageous to have debt than equity, which is to the detriment of government in terms of tax collection. And that is what lead them to begin to ask questions. I want to reclassify a debt as equity for the purpose of getting appropriate share of revenue for government. Thank you.
Thank you, sir. Thank you so very much for that contribution. Yeah, we are getting towards the end. So Oluseyi Adedoyin would like to know what document is covered within the framework contemporaneous document. Is it only the TP documentation file?
All right, I would take that question. So your transfer pricing local file and your transfer pricing master file both form 2 out of 3 documents that you typically call the 3-tier documentation under transfer pricing. Number 3 is the country by country reporting reports, which is not mandatory for everybody that will be affected by transfer pricing. There's a different threshold for that. Now, for TP documentation, it's not just the local file or the master file that you've prepared. Remember that to prepare your local file or your master file, you would need other supporting documents, right? You would need invoices, you would need ledgers, you would need audited financial statements, you would need emails, correspondences showing that certain services were provided. You would need allocation schedules. You would need minutes of meetings, different types of records, just to show that the transactions actually occurred, so that you can substantiate it in the event of an audit. So all these documents that would form the basis of the information you are putting into your transfer pricing master file or local file are what you call contemporaneous documentation. It means that if I'm preparing a transfer pricing documentation for 2022, whatever information that is flowing into that documentation has to be for that period. You can't use documentation for 25, financial year 25 to prepare a documentation for 2022 because the economic circumstances, for example, will be different. So you need to make sure whatever information you are using is contemporaneous and stored as part of your TP documentation file. So I give you an example. Under audit, aside the master file and the local file that the NRS would typically request, they would ask for other supporting documents. And those information must tie to your TP returns and your local file. They would ask for your tax computations, they would ask for your your audited financial statements. They would even go as far as asking for your payroll, just to understand, certain information that you might not have provided to them in your local file. I hope that addresses the question.
All right, thank you. If there's no contribution from Mr. Tayo or Mr. Joseph, Taiwo Wahid is asking if a settlement or movement of stock within two separate hospitality business owned by same director in Nigeria constitutes a transfer pricing and filing obligation on the company. It says they are both Nigeria companies.
Okay. I don't know if Ogata was trying to speak. Okay.
That's fine.
Or should I take it again?
Address it properly.
Yeah, I think we heard it. I
heard
thought
the
you wanted to
question.
respond to it.
Yeah.
Okay, so the short answer is yes. If you heard when was speaking earlier with the kind of transactions that, so the question is that a related party transaction? The answer is yes. We are saying even balance sheet movements that have the ability to affect profit or loss are transactions that fall under the ambit of transfer pricing. So I think I saw a similar comment, and so maybe I will address it, because the concern when you read the question is that they are both Nigerian companies. That does not affect the fact that it's a transaction that is covered by transfer pricing in Nigeria. If you go to some other countries around the world, their transfer pricing regime only covers cross-border transactions. However, in Nigeria, transfer pricing covers both domestic and cross-border transactions. And in certain cases, with good reasons, there's a possibility, for instance, that one entity within a group is loss-making, while the other one is profitable. The transfer pricing team, the taxman, still wants to look at such transactions because of the time value of money. Or one entity can have tax assets such that it's not going to pay actual cash tax in the next 5 years, while the other one is exposed to that. So there are also different tax profiles. One of the entities may be in the free zone. One of the entities may, for instance, be now under the new law, what we called Pioneer before. So having the tax holiday priority sector under this new law. So there are various reasons why you can say the Nigeria in its wisdom decided to allow to make transfer pricing apply to both cross-border and local transactions.
Okay, thank you, sir. I'm scrolling through to ensure that I captured all the questions before we think we still have some few minutes. There is this particular question that wants to know if a company can continue to evade tax. It says that how long can a company keep covering up its tax evasion practices? And the question is from an anonymous attendee. Is it for a company who has repeatedly declared loss in her audited financial statements? What is the consequence, and how long do you think the company can keep on covering their tax evasion practices?
All right, okay, Adefemi, please, you want to take it?
Yes, I can, yeah. So maybe one thing I should clearly state is repeated losses, right, over several years do not automatically mean that you are evading taxes. I mean, it's a risk trigger for an audit, whether it's tax audit or transfer pricing. Because if you think about it, many legitimate businesses in Nigeria incur losses for several reasons. It could be due to economic conditions, high startup costs, macro factors in the market, operational challenges. Now, the problem will typically arise where a company is artificially creating or overstating their losses to avoid paying taxes. Now, that obviously would constitute tax evasion or tax fraud, which could open up investigation, recovery as well. So as much as you are incurring losses, right, you're having losses that are, happening every year, you must have relevant documentation to substantiate the fact that these losses are not arising as a result of your intercompany transactions. That's one. Now, if they are indeed arising because of your control transaction, let's say you are buying raw materials from your foreign related party, and because of the fluctuation in the naira versus the dollar, you are having huge foreign exchange differences. That is, overstating your losses. Of course, for tax purposes, the question is whether it is realized or unrealized. But irrespective of the treatment in your tax computation, you need to be able to explain that whatever loss that you have incurred as a result of that transaction is not because of your pricing, right? You need to be able to tie such losses to the macro environment, which, to be honest, is outside your control. But if you think about it as a business, if you make losses for 10 years straight, for example, that should be a concern. Any investor would have to look at it deeply and say, why am I still investing in Nigeria if I'm not getting my return on that investment? So I think it's a big concern, but it is not necessarily a case of tax evasion. Hello,
Yes, thank you.
Mrs.
Yes,
Oti?
great.
Okay.
Yeah, I had a little distraction. Thank you so much. I really appreciate every single one of you, and I'm sure that the participants really had a wonderful time. We have taken all the questions, the other administrative questions, please. You can reach out to us, those that made payment before and knowing that the webinar is a free webinar, just reach out to me either via mail or call. And any other administrative issues, please just reach out to me. And you can see the emojis going up. We had a wonderful time. Thank you, Tayo, for your contributions. It's been so great. Thank you so much. I would like to call on, don't let me do somebody else's assignments. Let me call on Mr. Dini Onobanjoni. He's going to do closing remark for us. He's part of the organizing committee of the board for the webinar. Thank you, Mr. Onobanjo. You have the floor.
Yeah, good morning, good afternoon, wherever you may be around the globe. My name is Niyi Onabanjo. I would like to say thank you to the organizers, the speakers, and it is also worthy of note that this topic is an interesting topic, and considering its importance within the tax space, I've really enjoyed it, and I hope we also enjoy the same. On that note, I would like to thank Mr. Adefemi Olaore and Mr. Joseph Alatishe. I also want to say thank you to the chairman and the co-chairman. On behalf of the Governing Council, we say thank you to you and thank you for your time. And we hope if we call you again, you answer our call. Thank you so much. And thank you so much for those that also join our professional colleagues. And we hope this will also broaden the frontiers of knowledge you've gathered today. And having said that, we hope we continue to gather together like this in the future. And thank you so much for the Secretariat for putting this together. Thank you.
Thank you, everyone. Thank you, sir. Thank you so very much. It's been a wonderful session. We appreciate every one of you, our panelists and our participants. We appreciate the faculty board members on the call. We appreciate council members on the call. We appreciate every one of you. And I would just like to say that to ensure that we capture all your information for the 2 credits, please ensure you complete the form that was dropped on the link, both on the YouTube and on the Zoom link. And I also want to encourage you to visit the website, the training website. The list of all our trainings are there, both the faculty training, the MPD training, and the entrepreneurship. Kindly visit the Institute website and make sure you benefit from the list of available trainings. Thank you so much, as we call it a day, and we look forward to seeing you in other webinars. Have a beautiful day. Thank you all.